Welcome to the deep dive. Today, we're navigating a part of your financial world that often feels like a dense, complex forest. We're talking deductions and losses. It sounds complicated, I know, but it's absolutely crucial for your financial understanding, maybe even resilience. Our mission for you today, pretty clear. We're taking a stack of incredibly detailed info, the kind tax pros spend hours on and pulling out the most important stuff, the surprising nuggets of knowledge, hopefully. The goal is for you to feel more informed, more prepared, really, more in control when it comes to, well, money you don't get back, investments that go south, or maybe property that gets damaged unexpectedly. And we're focusing on individual income taxes for 2026. Before we really jump in, though, maybe we should quickly touch on three terms we'll be using a lot, just to make sure we're all on the same page. First, ordinary income. That's your regular earnings, right? Salary, business profits, maybe interest.
Exactly.
Yeah.
Then you've got capital gains or losses, think stocks, bonds, real estate, selling those for more or less than you paid. And the key thing, really, is that the IRS often treats losses against ordinary income very differently than capital losses.
Right. And the third one, adjusted basis.
Ah, yes, adjusted basis. Basically, think of it as your cost in an asset. Your investment, maybe adjusted for things like improvements or depreciation if it's business property. It's your stake in it for tax purposes.
Got it. Okay.
And, this isn't just about crunching numbers. It's really about understanding financial resilience. The tax code, yeah, it's complex, but it does provide specific ways to get relief when losses happen. What's really fascinating, I think, is how it separates business from personal situations. That distinction, it dramatically impacts how losses are treated.
Okay, let's unpack our first big topic then. Bad debts. So imagine this scenario, someone owes you money, maybe a friend, family member, or even a client, and they just can't pay. Or maybe you won't pay. It's frustrating. What are the tax implications?
Absolutely. When a debt becomes truly uncollectible, you might be looking at what's called a bad debt deduction. Now, the primary rule, especially if it's related to your business income, is that the income tied to that receivable must have been included in your income before. This also applies if you made a loan that isn't repaid, or even if you bought debt, like a bond, and it goes bad.
So how do you actually claim this? I've heard about the specific charge-off method. Is that the main way?
That's the standard, yeah. For most taxpayers, that's the method. You claim a deduction in the year when a specific business debt becomes either partially or wholly worthless. So you don't have to wait forever if it's pretty clear the money just isn't coming back.
The tricky part, I imagine, is proving it's worthless. That's where people might get tripped up, right?
Definitely. You absolutely need to document your efforts to collect and why it's worthless. But, and this is important, you don't always need to go through lengthy legal proceedings. If you can clearly show collection is unlikely, maybe the debtor disappeared or, like you mentioned, filed bankruptcy, that could be enough. Bankruptcy itself is often a strong indicator, sometimes allowing a deduction even before everything's fully settled.
Okay, and you mentioned business debt. Is there a difference if it's not related to business?
Ah, yes. Huge difference. And this is critical for your listeners to understand. We need to distinguish between business and non-business bad debts.
Okay, laid out for us. What's the difference?
So a non-business bad debt is one that's, well, unrelated to your trade or business, either when you made the loan or when it became worthless. The really crucial thing here, the IRS treats this loss like a short-term capital loss.
Ah, okay. So that means it primarily offsets capital gains.
Exactly. And you're limited to deducting only $3,000 of net capital loss against your ordinary income each year. That limitation can really blunt the immediate tax benefit. You might carry that loss forward for years. The classic examples, loans to friends, loans to relatives, those are almost always non-business.
Okay, and the flip side, business bad debt.
Much better treatment. A business bad debt is treated as an ordinary deduction in the year it happens. Ordinary deductions directly offset your ordinary income salary, business, profits, etc., dollar for dollar, much more favorable. Plus, with business debts, you can sometimes deduct partial worthlessness. You don't have to wait for it to be completely gone. Generally, any loan made by a business as part of its operations, assumed to be a business debt. This distinction is vital.
So let's go back to those loans to family or friends. Many people do that. How do you make sure the IRS sees it as a genuine loan, not just a gift? Because if it's a gift, no bad debt deduction, right?
Exactly right. No deduction for a gift. And this is where things can get messy with loans between related parties. The IRS looks very closely at the circumstances. They want to see signs of a real lender-borrower relationship, not just generosity disguised as a loan. Key factors they examine. Was there a formal promissory note signed?
Like actual paperwork.
Yes, actual paperwork. Was a reasonable interest rate charged or lease dated? Was any collateral involved? Crucially, if payments were missed, did you actually try to collect,
Hmm.
make demands? And fundamentally, what was the intent of both people when the money changed hands? Was it truly expected to be repaid?
So, if Alex lends his sister $20K for a business idea on a handshake,
And the business fails, Alex might be out of luck for a deduction. Without that documentation, the note, interest collection efforts of the IRS, is very likely to call it a gift. Documenting everything rigorously upfront can make all the difference in proving it was a real loan gone bad.
okay, that's super helpful for personal loans. Let's shift gears slightly. We talked about money owed to you. What about money you invested? Stocks, bonds. Sometimes those investments become completely worthless. Any relief there?
There often is, yes, but it usually falls under those capital loss rules we just talked about.
Yeah.
Generally, when your stock, bonds, notes, things like that become completely worthless, the tax rules treat it as a capital loss. And here's a funny quirk. The loss is deemed to have happened on the very last day of your tax year.
Really? Even if the company went bankrupt in, say, March?
Yep, deemed to occur December 31st for figuring out if it's short-term or long-term. And again, because it's a capital loss, you're generally subject to that $3,000 annual limit against ordinary income after offsetting any capital gains.
Okay, but I know there's a potentially really interesting exception here, especially for people investing in smaller companies. Section 1244 stock.
Section 1244. Yes, this could be a huge deal for investors in qualifying small businesses. It's a specific type of stock, often just called small business stock.
And what makes it so special?
It completely changes the loss treatment. Instead of a capital loss, losses on Section 1244 stock are treated as ordinary losses.
Ordinary loss. So directly offsetting regular income without that $3,000 cap.
Exactly. That's the game changer. It lets you deduct much more of your loss against your salary, business income, etc. in the year it happens. It's basically designed by Congress to encourage investment in small businesses by offering better tax treatment if the investment doesn't pan out.
Okay, that sounds great. Are there catches, limits?
Oh, definitely. There are specific requirements. First, the ordinary loss treatment is capped. It's limited to $50,000 per year for single filers or $100,000 if you're married filing jointly. Any loss above that limit reverts back to being a capital loss.
50,000 or 100,000. Okay. What else?
The corporation itself has to meet certain tests. Critically, the total money and property it received for all its stock can't have exceeded $1 million when your stock was issued. It has to be a relatively small corporation capitalization-wise. And you, the shareholder, generally have to be an individual, and you must have acquired the stock directly from the corporation, not from another shareholder.
So if Sarah invests, say, $75,000 in a startup that qualifies.
And it unfortunately fails completely. If it's not Section 1244 stock, she has a $75,000 capital loss, only $3,000 of which likely offsets ordinary income this year. But if it does qualify as Section 1244 stock, she could potentially deduct $50,000 if single, or the full $75,000 if married filing jointly under the $100K cap as an ordinary loss this year. That directly slashes her taxable income. It's a massive difference in the immediate tax benefit. Really helps cushion the blow.
Wow, okay. So a very different, much more beneficial outcome for certain small business investments if they fail. That's a strong incentive. Now, let's bring this closer to home for many listeners. Losses of individuals, specifically personal property. What happens if, your stuff gets damaged or stolen? My understanding is personal losses usually aren't deductible, but there are exceptions.
That's the general rule, yes. But Section 165C of the tax code carves out three main categories where individuals can deduct losses. 1, losses incurred in a trade or business, we've touched on that. 2, losses in transactions entered into for profit, like selling stock at a loss. And 3, the one most relevant here, losses from fire, storm, shipwreck, other casualty, or theft.
Other casualty. What qualifies as casualty? Is it just any damage?
No, it needs to be more specific than just any damage. The event must be identifiable, damaging to property, and this is key, sudden, unexpected, and unusual. Think sudden events like hurricanes, floods, tornadoes, fires, earthquakes, even car accidents.
Okay, sudden, unexpected, unusual. What's not a casualty then?
Right. Progressive deterioration doesn't count.
Yeah.
Things like termite damage that happens slowly over years, or rust or erosion from wind and rain over time, that's considered maintenance or just wear and tear. Also, a decline in property value without direct physical damage isn't a casualty loss. So if, say, a landslide happens nearby and makes your neighborhood less desirable but doesn't actually damage your house, no casualty loss deduction for that drop in value.
That clarifies things. Needs to be sudden, direct damage.
Yep.
But there's a really big catch right now for personal casualty and theft losses, isn't there? A time-sensitive one.
There is indeed, and this is absolutely critical for listeners to understand for tax years 2018 through 2025. Due to tax law changes, personal casualty and theft losses are only deductible during this period if the loss occurs in a federally declared disaster area.
Only in a federally declared disaster area. Wow. So if my basement floods due to a heavy rainstorm, but it's not declared a federal disaster.
Then, unfortunately for these years, that loss is generally not deductible. This rule significantly narrows the scope for personal loss deductions right now. Unless Congress changes the law again, this limitation is in effect through 2025.
That's a huge limitation. Okay, what about theft? Does just misplacing something count? I seem to lose my keys constantly.
No. Unfortunately, lost keys don't count. Theft requires an illegal taking. Think larceny, embezzlement, robbery. It specifically excludes items that are simply misplaced or lost. And theft losses are generally deducted in the year you discover the theft, which might not be the year it actually happened. Also, insurance matters. If you have an insurance claim and you reasonably expect full recovery, you can't take a deduction. If you expect partial recovery, you can only deduct the part that insurance won't cover, subject to other limits.
Okay, so assuming it is a deductible event, like a fire in a federally declared disaster area, when do you deduct it? And how much?
Good question. Timing. Usually you deduct it in the year the loss occurs. However, there's a special election specifically for losses in those federally declared disaster areas. You can choose to deduct the loss on your tax return for the year before the disaster happened.
The prior year. Why would you do that?
It's designed to speed up relief. By amending your prior year's return, you can potentially get a tax refund much sooner, rather than waiting until you file for the year the disaster actually occurred. It helps get cash in hand faster when you really need it.
That makes sense. Okay, and how do you measure the amount of the loss?
It depends. If business or rental property is completely destroyed, the loss amount is generally its adjusted basis, basically, your investment cost. But if business or rental property is only partially destroyed, or if it's personal use property, whether partially or completely destroyed, the calculation is different. It's the lesser of two amounts. Either the property's adjusted basis or the decrease in its fair market value right before versus right after the casualty.
Decrease in fair market value. How do you figure that out?
Usually with appraisals, you get an appraisal of the value just before the event and just after. Sometimes, though, the cost of repairing the damage can be used as a measure of the decrease in value, but there are rules around that too. The repairs have to be necessary, not excessive, only fix the actual damage, and can't end up making the property worth more than it was before the casualty.
Right, and for these personal casualty losses, even if they're in a disaster area and you calculate the amount, there are still reductions, right? Floors.
Yes, exactly. Two important floors apply to personal use property losses, and they come after you figure out the initial loss amount and subtract any insurance reimbursement. First, there's a $100 reduction per event. Not per item, but per casualty event. Then after applying the $100 floor, you take all your net personal casualty losses for the year. Remember, only those from federal disaster areas are deductible now.
Yeah.
And you can only deduct the amount that exceeds 10% of your adjusted gross income, or AGI.
10% of AGI. So if your AGI is, say, $80,000, you need at least $8,000 in net casualty losses after the $100 floor before you can deduct anything above that $8,000.
Precisely. That 10% AGI floor is a significant hurdle. So even in a declared disaster, many smaller losses won't result in a deduction because of these two floors.
It seems like it gets even more complicated if you have both personal casualty gains, like maybe insurance paid you more than your basis and losses in the same year.
It does get a bit intricate, yes. There are special netting rules. The simplest way to think about it now, given the disaster area limitation, a personal casualty loss that's not from a federally declared disaster. It's basically only useful to offset any personal casualty gains you might have. Any leftover non-disaster loss isn't deductible. If you still have a net gain after that, then you offset it with your deductible federally declared disaster losses. If, after all that, you still have a gain, it's typically treated as a capital gain. If your deductible disaster losses exceed any gains, then gains and losses up to the amount of gains are treated as ordinary, and the excess disaster loss is deductible, subject to that 10% AGI floor. It prioritizes deducting the disaster losses. Okay, wow, lots of layers there. Let's shift gears again to some more specific business topics. Research and experimental expenditures, R&E, important for innovative companies. Yes, R&E. This covers costs for, developing or Improving products, processes, formulas, that kind of thing. Think lab work, experimentation. It's important to note what it doesn't include. Routine quality control, testing of existing products, efficiency surveys, advertising, promotional expenses. And there's been a major change here recently that businesses really need to be aware of.
A recent change. What's that?
For tax years, starting after December 31st, 2021, businesses can no longer immediately deduct these R&E expenses. Instead, they must be capitalized and amortized, basically, spread out and deducted over time.
Amortized. Over how long?
Over 5 years for research conducted in the U.S., and over 15 years for research conducted outside the U.S. And the amortization starts at the midpoint of the year the expenses are paid or incurred. The big impact for businesses. It delays the tax deduction, affecting cash flow. Instead of getting the full benefit up front, it's spread over several years.
And what if they start a project and then abandon it? Can they write off the remaining costs then?
Not immediately, unfortunately. If a project is abandoned, the unamortized amount isn't deducted all at once. You continue to deduct it over the remaining 5 or 15-year amortization period.
Ouch. Okay, that's a significant shift. What about situations where a business just has a really bad year, maybe massive losses?
This brings us to a concept called excess business losses, or EBLs. This applies to non-corporate taxpayers, so individuals, partners, S-corp shareholders. Essentially, if your total business losses are really large in a given year, there's a limit on how much you can deduct against your non-business income in that year.
A limit. How does that work?
An EBL occurs when your total aggregate business deductions exceed the sum of your total aggregate business gross income and gains, plus a specific threshold amount. For 2025, that threshold is $626,000 for married couples filing jointly and $313,000 for everyone else. These numbers adjust for inflation each year. Any business loss above that threshold, that's the excess business loss, and it's not allowed as a deduction in the current year.
Not allowed at all, so it's just lost.
No, not lost, thankfully. Instead, the EBL is carried forward to the next tax year, but it's treated as part of a net operating loss, or NOL carry forward. The whole point of the EBL rule is to limit the ability of taxpayers to use large business losses to zero out, say, large investment income or spouse's salary in the current year. It's applied after other limitations like the passive activity loss rules.
Okay, so that leads us directly into net operating losses, NOLs. What are those exactly?
Right. And NOL happens when your allowable deductions, primarily business and casualty losses, are greater than your gross income for the year. NOLs are basically a way the tax system tries to average out income over time, recognizing that especially for businesses, income isn't always stable year to year. It provides a measure of fairness in a progressive tax system.
Makes sense. How do they work now? Have the rules changed for NOLs too?
Yes. The rules have changed significantly in recent years. For NOLs arising in tax years starting after December 31st, 2020, there are two main things to know. One, carry forward only. Generally, you can only carry these NOLs forward to future tax years. The option to carry them back to prior years, which used to generate quick refunds, is largely gone for most taxpayers. They can be carried forward indefinitely, though.
Carry forward indefinitely. Okay, what's the second thing?
2. NOL deduction limit. When you carry an NOL forward to a future year, the amount you can deduct in that future year is limited. Your NOL deduction is capped at 80% of your taxable income for that year, calculated before you take the NOL deduction itself.
80% limit. So even if I have a huge NOL carried forward, I might not be able to use all of it to wipe out my income in a good year.
Exactly. That 80% limit means it might take longer to fully realize the tax benefit of the NOL, potentially spreading it over more future years. Also worth noting, the Qualified Business Income Deduction, QBI, or Section 199, can't create or increase an NOL, and NOL carryforwards don't reduce self-employment income for self-employment tax purposes.
Okay. And computing the NOL for an individual, I assume it's not just subtracting expenses from income.
Right. For individuals, there are adjustments. You start with your taxable income or loss and have to add back certain things that aren't allowed in the NOL calculation. For instance, you generally can't include non-business deductions that exceed non-business income. Capital losses have limits. The QBI deduction isn't allowed. It's a specific calculation to isolate the true business operating loss.
Understood. So wrapping all this complexity together, knowing these rules, what are some smart ways people should be thinking about planning, maybe strategically, around potential losses?
While thinking strategically, 2 points we discussed offer clear planning potential. First, revisiting Section 1244, stock losses. Remember that $50,000, $100,000 annual limit on ordinary loss treatment. If you have a large block of failing 1244 stock, you might actually benefit from selling it off over more than one tax year, if feasible. Selling just enough each year to stay under the ordinary loss cap could maximize that favorable ordinary loss treatment, rather than taking a huge hit in one year where much of it becomes a less useful capital loss. It requires careful timing.
That's a clever timing strategy. What's the second point?
The others for casualty losses, specifically for losses in those presidentially declared disaster areas. Don't forget that special election to claim the loss in the prior tax year. This doesn't change the amount you can deduct, just the timing. But accelerating that deduction can mean getting a refund much faster, providing critical cash flow right after a disaster. It's an important option to be aware of if you're ever in that unfortunate situation.
Excellent points. Well, we've certainly navigated some intricate territory today: deductions, losses, bad debts, worthless stocks, casualties, even the big business loss rules like EBLs and NOLs.
It's really fascinating when you step back is seeing how these rules try to strike a balance. They aim to provide real relief for genuine economic losses, while also putting up guardrails to prevent abuse. Understanding those distinctions, we talked about business versus non-business debt, Section 1244 stock, the disaster area requirement that really transforms these from just, obscure tax code sections into potentially powerful financial tools. I think the biggest takeaways for you are documentation, 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 and really understanding the category your loss falls into. That determines everything.
Absolutely. We hope this deep dive has given you, our listeners, some key insights, maybe a few aha moments about how these rules work and how they might impact your own financial decisions and planning. So here's a final thought for you to chew on. Given all these nuances, business losses, personal losses, investments gone wrong, how might truly understanding these rules empower you, not just to react when things go wrong, but to proactively plan for financial resilience in what is, let's face it, an unpredictable world? Being informed about these avenues for relief could really change your financial outcome when the unexpected happens.